what I'm going to do today is I'm going to focus on some of the charts. I mean, if you're a regular watcher of Market Watchers Live, then you're probably going to be familiar with a number of these charts I'm going to show. We're in a different market today than we've been in quite some time. This is a market that's been extremely volatile. We've broken below some key price support levels that would suggest that we moved from a correction to a bear market. And so the way I approach tops and bottoms in a bear market is a lot different than the way I approach a bull market. I know Arthur Hill wrote an article, I think it was over the weekend, talking about how you have to be careful when you're in a bear market, because now instead of expecting price resistance levels to break to the upside, you're expecting them to hold, and you're expecting support levels to break instead of hold. So it's kind of a reversal to what you're looking at in a bull market. So I'm going to start by going over some of the charts that I've shown recently on the show, looking at some of the past bear markets. So let's go ahead and start with that. Okay, the first chart I have here is a chart of the S&P 500. Currently, this is where we are, and we have broken a little bit higher, so I could have changed this Fibonacci a little bit higher. We're probably up now over 11% on the S&P 500, and we have cleared 2,600, the level that Aaron had mentioned earlier in the show, and that was a level that we did see back in earlier in December. I think this low came down below 2,600, but we didn't have any closes below that 2,600. And then, of course, we could go all the way back to the February and April lows, where we had established what I consider to be very significant support back at 2581 on the S&P 500. Now, what I look at when I'm looking at a bear market, I really change a lot of what I look for in terms of bottoms. Instead of necessarily looking at support, price support, which typically holds during bull markets, I look for those price support levels maybe not to be so great during a bear market. Now, I'm not going to go into it, but I have recently talked about the fact that I believe we're in a secular bull market, meaning that I think the big picture long term is higher. In fact, I think we're going to go much, much higher. But you can have bear markets, cyclical bear markets within a secular bull market. And that's what I think we're dealing with here. Now, because I think ultimately this is going to resolve to the upside in a big, big way, I do not want to try to impose my will on the market and say, listen, this market's got to go down. Therefore, I'm going to stick with my shorts, or even worse, I'm going to start adding to my shorts, because because the bigger picture, the long-term picture is higher. This could be a V bottom, and I'm not saying it is. I don't think it is, but I do think that there is the possibility, more so than maybe what we've seen in prior bear markets, or certainly the more recent bear markets back in 2007 to 2009 and 2000 to 2002, because those were part of secular bear market, that are part of a secular bear market. And so we should have expected longer periods of sideways to down action. Okay, so looking at this chart, the thing that I have on all of these charts, you'll see, is at the top I have the PPO, then I have the price action for the S&P 500, and this is all 2018, the early part of 2019. I've got the volatility index down here at the bottom, and then all the way here down at the bottom, I've got the put-call ratio. And what I've done here on the put-call ratio, and I'll show you my settings, I've gone with a 5-day moving average of the put-call ratio, because the put-call ratio every day, it just gets really, a lot of back and forth, a lot of noise. But I think over a 5-day period, you get a pretty good sense of what's going on. So down here at the bottom, the way you can set that up is under your indicators, you can put in price, the $ CPCE, that's your put-call ratio. And then under your style here, you can go with invisible. So invisible means that you're not going to see all that daily action. Instead, I have a simple moving average, 5-day. And that's what you're seeing up here, is simply the 5-day moving average. Right over here, you can see MA, 5 in parenthesis. So it's just a way to silence all of that noise back and forth and try to find some meaningful information. I mean, maybe you could, test it and go with 10 days instead of 5 days. Maybe 3 days is better. I went with 5. I think the 5 works pretty well. So I just wanted to show you how this chart is set up, because the other charts I show you as we go back in the prior bear markets, I'm going to have similar looking charts. Okay, so one of the keys, and I always say when we're in a bear market, I don't look at price support. In other words, when we break it down here at the 2581 level and we clear those prior lows to the downside, I think you have to be real careful about trying to go back onto a prior chart a year, 2 years, 4 years ago and find a support level. Because when you break a major support level like this and the volatility index shoots up, I refer to a period like this as market makers going on vacation. It's like they're matadors and they're just holding up that little, red sheet for the bull to go flying through. There's just nothing there to support the market. So when I look for in terms of trying to spot bottoms in this kind of a market is the extreme readings in the volatility index and the extreme readings in the put call ratio. So if you notice, two of the big levels in 2018 was that initial push or pullback in late January into early February when we established that 2581 low. You can see the VIX shot up to 37, which historically, I don't have a long-term chart, but when you start getting VIX readings into the mid to upper 30s or into the 40s, that tends to be a really significant area. That's when the baby's going out with the bathwater, when you start getting VIX readings like that. And you can see that when these bottoms finally print, you can have massive rallies back to the upside. And missing some of these rallies can be painful, although you can see back in February when we went down, we had a rally. We ended up going back down and at least getting a double bottom before we started rallying again. Now, the problem with a volatile market is if you're off by a couple of days and trying to spot the bottom, that can cost you a lot of money. It's why I don't like to trade volatile markets, especially individual stocks. And I'm going to give you an example. This bottom that went in, and the bottom occurred, this close of 2581 was on February 9th. All right, I'm going to show you an article I wrote back on February 7th. I'll step out on that limb, the bottom is in February 7th. And the whole reason that I was talking about it was the volatility index had shot up. There were a number of reasons. You could go back through the article, but one of the key things is the volatility index moving up. And the other thing was we had a massive reversal in the market. So reversing candle off of this downtrend. So to me, that was a level of support. We'd gone just a little bit below 2,600, rallied back to 2,700. So I thought the bottom was in. Well, it turns out that we had one more move down. I missed by 2 days the low. But, and you say, well, 2 days isn't bad. Well, if you were in, and let's say you bought at the end of the day, and I don't remember exactly what my trading positions were, but I'm pretty sure I got stopped out over the next couple of days. Here you can see the S&P 500 was back up at about 2,700 off of that reversal in early February. 2 days later, well, actually 3 days later, intraday, we were down to 2,532. So we fell 168 points in the next 2.5 days after I made that bottom call. That was painful. And you might look back and say, well, looking back, it would have been pretty easy just to jump in and wait. But in the moment, missing by 2 days and this big red candle right here, emotionally, that takes a huge toll on you. So if you're just off by a couple of days in trying to spot a bottom, it can be incredibly painful and very emotional in terms of trading. So that's why, again, I don't like high volatile markets. I don't like all the selling and the volatility that it creates, because you start getting all of this whipsaw back and forth. You think you have a bottom, and then you think, oh my gosh, here we go. Where's the next low? When you break down. And then 2 days later, we're back up. 3 days later, we were back up to 2,700 again. And it's just really difficult, really plays on your nerves. So, but when you look back, you can see the VIX did mark a very significant bottom here. When we went back in April, and I'll pull up the next article I had here. This was on April 2nd. U.S. stock slide is S&P 500 prints double bottom. It's exactly what we ended up doing. We had a nice little rally, pulled back. We still held on to that major support level and then rallied throughout the summer. Now, the next key was coming down here on December 17th and making this breakdown. And as this was actually on the 17th that morning, and I posted S&P 500 nearing significant breakdown, bull market running out of steam. And of course, it did end up breaking down. And then right on the 26th, when we hit this bottom, this one I actually did hit as far as the timing goes. I said we're nearing our first major bear market bottom, and that was on the 26th in the morning. And of course, that's where we bottomed on the 26th. So my point is, I didn't look at price support here and trying to call this bottom. And honestly, I wasn't looking for price support over here. I was using reversing candles. I was using the volatility index and those types of things to call bottoms. It was not price support from a prior low. So I think when you get into a bear market, you have to rely less on moving averages, less on price support, less on maybe individual candlesticks. I mean, you could see that one, looked like a great reversal. And then 3 days later, we were right back down below it. So that reversing candle didn't really help. Those types of things, I think you have to be careful because you're in a different market environment. Now, let's go down here to the CPCE. This is the put-call ratio. Now, the reason that this is important is you're looking at the number of equity puts and equity calls that are traded. Now, you don't know whether or not the puts are being bought or sold at the open. You just know the number of puts and the number of calls being traded. So that makes it a little bit more difficult. But the majority of traders buy puts to open and buy calls to open. It was a study I looked at years ago. I'm assuming it probably hasn't changed much. But most traders, there are some who will sell puts to open, sell calls to open, but most of them buy. Now, when they're buying puts to open, they're expecting the market's going to go lower. And the problem with most traders and most people is that we do like to tend to follow the masses. And usually the masses get it wrong because every time the stock market, you see a lot of folks piling in on one side of the trade, you have to keep in mind that you've got market makers on the other side that are going to profit from these massive reversals. So again, you're using the VIX because of the the extreme reading in the VIX. That's a sentiment measure. And then also when the put call ratio gets extremely high over a period of 5 days, that is telling you that the market that traders are buying a lot of puts, believing that the market can only go in one direction, which is down. And that's usually when the market reverses and goes up. So here, and Erin talks about this a lot with her weekly sentiment, talks a lot about equity put call ratio, talks a lot about the VIX and some other sentiment indicators. And really, it's just contrarian. You have to train yourself to believe that when everybody is in on one side of the trade, that is where you need to be thinking about the other side of the trade. And as hard as it is to do, because from an emotional standpoint, market's selling off and it's literally cratering and tumbling day after day, it's really hard emotionally to say, oh, I'm going to buy and try to go against everyone. But when they do reach extremes, I think that is the key. Now, the other thing I wanted to point out on this chart, I know I'm spending a lot of time on this chart, but I think these are important concepts. I follow the history of the market, and I know that there are a lot of historical trends in play. And so I think that following historical trends also can aid you in terms of trying to identify tops and bottoms in both volatile and non-volatile markets. So bear markets and bull markets. What I've highlighted here on the S&P 500 is the annualized return by day of the calendar month. So 19th is not just the 19th of January. This is the 19th of January, February, March, April, all the way through December. All of the 19th of the month, you can see that they've produced annualized returns on the S&P 500 minus 33.44%. And this dates back to 1950. So this isn't just the 19th for the last 2 years or the last 5 years. This is going back 67, 68 years. Pretty, I would say, pretty representative sample. But the 19th, 20th, 21st, all the way through the 25th, the only positive day is the 21st. And if you look over here, the S&P 500 average annual return is 9%. So in a perfect world, what you would expect is that every day of the month would have annualized returns of 9%. But all days are not created equal in the stock market. And you can see the 19th through the 25th, even the plus 5% day, all of them are below the average annual return of 9%. This is the time of the month you want to be cautious if the market is doing well, and I'll point that out in just a minute. But if you think about it, 19th to the 25th, that is 7 days of every month, which is roughly 25% of the month. And think about that, 25% of all the calendar days since 1950 have produced an annualized return of minus 8.2%. That is the equivalent of about 16 years. It's over 4,000 trading days. So the equivalent of over 16 years. Imagine if I told you the S&P 500 was going to go down on average 8% a year for the next 16 years. How excited would you be to be in the market? That's the way you need to be thinking when you get into this period, 19th to the 25th. It doesn't go down every time, and I'm not trying to suggest that. But if the market has moved higher, and I'm going to show you some of these periods where we've seen rallies in the market. And notice that these rallies tend to go close to the middle of the month. And then all of a sudden we get these pullbacks. Well, 19th to the 25th does produce historically weak results. And during these rallies, what tends to happen, if you check out these rallies, what tends to happen is your put-call ratio tends to get down close to low levels, meaning now the tops mean that a lot of puts are being bought. The bottoms mean that on a relative basis, a lot of calls are being bought. Now, sometimes when a lot of calls are being bought and the market keeps going higher, you think, well, why would that be? I mean, how can the market go higher if everybody's buying calls? We should be seeing reversals. Well, I want you to keep in mind that one strategy market makers can take, if you buy a call, the market maker can buy stock and essentially sell you the call. They're buying stock, selling you the call. What is that? Covered call strategy. So as long as the market doesn't completely take off to the upside, and let's say it just goes sideways for a while, they're selling you that call. You bought the call, it's going to expire, worthless or certainly less than what you paid for it. And at the same time, they own the stock, which has just gone sideways. So anytime you see the market or the put-call ratio declining and the market moving up, just keep in mind that there's probably going to be some headwinds in the short term that's going to keep a lid on prices as we move into option expiration Friday, which is always the third Friday of the month. And what I've noticed, especially with this data down here, is that usually the week after options expire, the market tends to struggle. And I think a lot of it has to do with the option activity. So anyway, I've spent a lot of time on this chart, but I just want you to know that when you're looking for bottoms in a bear market, looking back, I mean, when I was looking here at December and I saw this prior support in a bull market, I would say, hey, let's look for a reversal. But on this breakdown, when you get that breakdown, you've got to turn your attention to these sentiment readings. Look at the VIX just exploding. And when I talked about that bottom on the 26th of December, what I mentioned was, and I'm pretty sure I put it in this article. Oh, I thought I put it in this article. Maybe it was in the one right after this. But what I was looking at is prior bear markets and those breakdowns. In fact, I can probably show you well, I'm going to show you the charts. I'm going to bring those charts up in just a minute. But anyway, that's what you need to be focusing on. You need to be focusing on these sentiment indicators when you're in a bear market, in my opinion, to identify bottoms. I would not necessarily be looking at prior lows going back a year or 2 years or 3 years. I think that can be a big mistake because, again, a lot of times the market acts as though, or market makers act as though they're just matadors and just letting prices go to the downside because they want to buy cheap. They're not going to try to support the market when everybody is exiting. They don't have the resources for it. If you think about that, roughly 40% of the stock market, and again, this is a ratio or a percentage that I've seen in the past, but roughly 40% of trades in the market are based on technical analysis. I don't know if that percentage holds true, but I'm assuming it probably does. Then when a market breaks down, you've got a lot of volume on the sell side when you start to see these breakdowns. Their market makers have limited resources. They can't simply buy everybody's shares that are being sold. So when you see too much demand or too much supply versus demand, then you're going to see these types of moves, and you're going to have to wait for the volatility to tell you that you've got a bottom. Just keep in mind this 36 reading on the VIX, because that's where we were in December at the low. Let's take a look at the next chart. This is the 2008 bear market. Now, this was a secular bear market versus a cyclical, but you still have volatility. Volatility is still going to make a difference when you get these peaks. Look at the August low. Now, here we hit support as we had a very high VIX reading. This particular bottom here, we got back up over 30 in the VIX. It did mark a short-term bottom, but that was nothing significant on the chart. Here, we broke down, and on this breakdown of the prior low, again, you can't really look back to find a price support level. What you're counting on is the volatility index marking a top. And look at those long tails to the downside. Only reason you have tails is somebody's finally stepping in on the buy side. Indication market makers are at least in the near term supporting prices. We got a bounce. Notice we go back down. We put in a double bottom. The VIX again high. We bounce. But ultimately, we ended up breaking down. This, again, was that 2007, 2008, 2009 bear market. Now, this is the only other chart where we see the equity-only put-call ratio, because the other bear markets, we didn't have this data available. But once again, look at the spikes in the equity-only put-call ratio as we're getting the spikes in the VIX and as we're setting major market bottoms. You really want to pay attention to sentiment. Now, some of these blue arrows, directional lines, again, are suggesting that when you get these rallies into the middle of the month, you want to be careful. Because you've got low equity-only put-call readings. Again, this is the 5-day moving average, and now we're on the low side, telling us that there's some complacency. Here's the move to the upside in the market. Here's your complacency. We're into the middle of the month where we start to see the market tend to weaken anyway, and there's a nice little downtrend. Same thing here back in July of 2008. Nice rally. You can see the low here at about 0.54. That was the lowest reading of the year. So very complacent as we're making this breakout middle of the month. And then look what happens. We move back to the downside. And then these other prior moves to the upside, for the most part, also coincide with low equity-only put-call readings, the 5-day moving average. Now here, I put in this question mark because, look, we went up, but we didn't really pull back. We just kept going higher. And you have to, again, keep in mind that market makers can be buying stocks. And so if they're buying, even if they're selling calls to you and me, and they're buying the stock, they have a covered call strategy. So they are protected. And you can see here the volume picking up on these moves to the upside as well, which to me also is indicative maybe of some market makers buying on that push to the upside. All right, next bear market. Now, this one I think, yeah, we didn't have the put-call ratio back then. But again, when you look at the bottoms, check out the VIX readings. Here we are in the low 30s. Now, this one, and this is why, let's say the VIX gets up to 32, 34 here on this breakdown. We were just breaking down below this level, and the VIX was probably at that 32, 34 level. Had we, you want to keep your stops in play, because had we put in a buy at support here, this we would have lost roughly 14% in about 3 or 4 trading days as that VIX shoots up to 44. Now, 44, when you go back long term, that is a very significant bottom in the VIX, or top in the VIX, bottom in the market. The only other time that we saw anything above that level, I believe, was at the 2008, one of the 2008 lows, where we saw the VIX when we were having the financial crisis. I think the VIX on an intraday basis shot up to like 90 and then came, of course, crashing back down. But that was really extreme. But historically, when you look back long term, you get a VIX reading in the 40s, you're probably getting very, very close to a bottom. Now, one strategy might be if you're out of the market and you're seeing that kind of weakness to the downside, perhaps think about working your way into a position. And again, I like using ETFs as opposed to individual stocks, because if the market's going down another 13 to 14%, you can only imagine what some of the aggressive stocks were probably doing in that time frame. All right, next bear market. This was 1998. And again, check out the VIX. Almost every significant bottom came with the VIX. Here was the VIX again, extreme readings back mid 40s. So, and in 1998, by the way, we were still in a secular bull market. So you're getting extreme pessimism marking a double bottom in a secular bull market. And look at the rally that came out of that. I think we possibly could see something like this. I'm not sure. Hopefully we'll get this double bottom, maybe even go lower in 2019. But I think once it's done, I think we're going to have something similar to this. I think 2019 is going to be a big year at the end of the year, potentially. I'm still a little nervous about the first quarter. And then the final one was the 1991 cyclical bear market. I didn't put the VIX in this one. And I think the VIX was, let's just, let me put this in real quick. All right, there we go. Okay, so when you look at the bottoms on this market, again, this is another bear market. It was short-lived, but it was a bear market. Look at the VIX readings. So this support over here didn't hold. We had this double bottom. We lost it. The VIX shoots up to 36. Very similar to what we saw. And going across here, you can see major bottoms printing when we get those VIX readings at 36. Okay, so let's go ahead. I didn't really talk too much about bull markets. We've spent plenty of time throughout the years talking about bull markets. I really wanted to talk more about bear markets. And here, when you're taking a look at tops and bottoms in bear markets, I'm always looking at the VIX, always looking at the put-call ratio, because a bear market is defined by emotion. It is defined by panic. And the best ways to measure those is the volatility index and the equity only put call ratio. Price support, a lot of times technicals you throw right out the window when you've got a bear market. So price support resistance, remember, in a downtrend, price support doesn't hold. That's how you have a downtrend. So in a bear market, I'm paying attention much more to price resistance than I am to price support. Same thing, the moving averages. Moving average resistance, like I showed you on some of those 20-week EMAs, instead of moving average support. Reversing candles, again, I'm going to be looking more at false breakouts, topping type candles, things that happen at resistance, as opposed to trying to find a reversal at the bottom, because my strategy in a bear market is going to be more to short. In a bull market, just to recap, we can bring this slide up again. Didn't really talk too much about the bull market, but it's going to be kind of the opposite. The VIX, when you get into a bull market, the VIX sits down in low numbers. It hardly ever budges. It's very boring. I almost never use the VIX in a bull market. Equity only put call ratio, rarely. If you look at a bull market, you're going to see the equity only put call ratio stay very low. You're going to think the bull market is ended constantly based on the VIX and the put call ratio, and it's going to give you wrong signals. Because again, you're not trading in an emotional market. So you want to be careful using those as your primary indicators. But price support, moving averages, and reversing candles, those I am going to use extremely often, and I'm going to use them mostly from a support perspective, not resistance, because again, resistance, we're going to tend to break to the upside. Support, we're going to tend to hold. So different markets. Okay, that is it for identifying tops and bottoms.